Hello everybody, this is Colin Murphy and welcome to Torcana Podcast 25. It's been a bit longer than usual since the last one, but I've just been crazy busy. I also moved house, and we all know how stressful that can be, especially when kids are involved. But getting back to business, I'm very happy to welcome Graham Parham to our show today. Now, Graham is probably the most investor-friendly lender I've come across in all my years buying and selling properties, and I'm delighted he found time to join us on the show today. So, Graham, how are you doing?
Hey, Colin, how are you?
I'm great. Listen, tell us a bit about yourself and your company.
My company's name is called Highlands Residential Mortgage. We're a privately held company, probably about 6 years old. The management of my company, or the owners of my company, have been around for several years and very seniored in our top management staff. We are corporately based out of Dallas, Texas. We do lending in quite a few states around the country. We are an in-house lender, which means we have all of our services in-house, the processing, underwriting, closing, funding, legal staff, the whole 9 yards, which makes it a lot easier, not only myself, but to all of my borrowers and consumers, because we're not a broker. We don't have to send our files across town or out of state. One of our claim to fames, like everybody's striving for these days, is service and closing quickly. And a lot of the national lenders, of course, some of the bigger banks, some of the other lenders, they're averaging about a 45, 46-day close, if not longer. Our average is right at 29 days. We can close a little sooner if all the moons are in line and everybody does their job correctly, but we try to make it as seamless as possible. I am personally an investor myself. As you well know, I bought a piece of property from you a couple of months ago.
Yeah.
And I currently have been an investor for probably, coming up on 15 years. Been working with investors for close to 20 years. And I found it extremely just a lot easier working with investors sometimes than first-time home buyers, because they're more educated. They understand the mechanics of trying to get things done in a timely fashion, and there's hardly any emotions, which helps out a lot. But I do enjoy working with investors, and I've worked with investors all over the country, all over the world for that matter. And we try to be as user-friendly, even for those people that are not living stateside, because we do a lot of business with people living abroad. Of course, we would prefer that, they are at least U.S. citizen or permanent resident alien. We are Fannie Mae and Freddie Mac lender. So we deliver our loans directly to that community. We do service probably 50 to 60% of our conventional loans, probably 100% of our government loans. But once again, I think our claim to fame is my team. My team is, in my opinion, a well-oiled machine, but I have my own underwriter. And if there's a loan officer out there listening to this broadcast, they know having your own personal underwriter really speaks volumes, because you don't have to deal with getting on the conveyor belt and having differences of opinion. The consistency of having the same underwriting, doing the same type of loans, especially in the turn-free type of properties that you're selling, as well as other individuals. Sometimes can be a little difficult with other lenders, and simply because the way the guidelines are written in Fannie Mae, they can be interpreted in a couple different ways. So there's many lenders out there, unbeknownst to the consumer, that won't even do a turnkey property loan, even if the borrower has 800 credit scores, $1 million in the bank, and make $1 million a year. They still won't do them, which is kind of crazy.
I know, I'm with you on that, and one of the reasons I like you is obviously because you're fast, but also because you understand investment, that you are an investor yourself. Whenever possible, I do like to work with other real estate investors. So, for example, the title agent I use, one of the reasons I like them is because they're investors as well. Even some of the other people we use for renovating our houses, a lot of the guys that own these roofing companies and AC companies also have their own rentals. So they all know how important it is to get things done properly, get things done quickly. And, I love working with your team. I do agree that they're a well-oiled machine, that they are always working to get the loan quickly for the borrower and to get the house closed. And I've had those properties where I have a buyer wanting to buy this property that will appraise all day long, but it'll just get turned down by one of the big lenders because they don't like working with turnkey operators. They want to see that I've owned it for 90 days and I might have owned it a lot less than that. So yeah, it's not just about the big brand bank. It's not just about the interest rate. There's a lot more that investors and a lot more important things investors need to think about, right?
Absolutely, absolutely.
So what types of loans are investors using to acquire rental properties? What are the best loans that investors are getting, and what kind of loan to values are they going at these days?
Well, needless to say, they're coming to you for a couple different reasons. A, to buy an asset, but also to create passive income. And the best way to accomplish your passive income and maximize that is to do with the best type of terms, which in this case would be a 30-year term. We actually had a 40-year term before the 2008 mortgage meltdown, and there's been rumors to bring it back. But it's all about cash flow, and if you can minimize your debt service payment and increase your cash flow, that's the key. So the best way to do it is with a 30-year fixed rate. Other investors have different opinions. They want to pay it off quickly, reduce their cash flow, and that's fine. We obviously have a 15 and a 10-year note to go that route if you so choose. None of our products have any prepayment penalties. These are straight manila flavored loans. Sometimes people will want to talk about the ARM products, and the ARM products were good in their day, but unfortunately right now, because we have a kind of an inverted indices going on in the marketplace and very little margins in those products, it's kind of difficult to go head to head with what the 30-year fixed rate will do. So I haven't really sold anything other than 30-year fixed rates, probably one out of 500 maybe go with a 15 or a 20.
I mean,
it's crazy.
One of the things, and I get it. I mean, if your aim is to generate the most cash possible from your properties, you want to extend that loan out, and a 30-year fixed is great to have that 30 years fixed. You know exactly what your payments are, and I mean, I'm guessing maybe if you already have a good job and you're more interested in building up equity and having that cash flow for when you're retired. Let's say you're 45 and you don't need the cash flow until you're 65, you could do a 20-year note. So then when you do retire, when you're 65, you've got these properties that are fully paid off and will be producing more cash flow in years 20 to 30 than the guys that are still, on a 30-year note, right?
Yeah, there's a lot of educators out there that are discussing different strategies of how to go about getting the cash flow and paying it down as well. So it's kind of having your cake, your cake and eating it too. And one of the ways people will do it is they'll get an inventory built up. Let's say they go out and get, say, 5 or 8 properties, and they've got some healthy cash flow coming in on the 30-year products, and all that cash flow they'll direct directly toward one loan and just start paying it down quickly. That's one method of doing it. Another one's just pay the additional principal to pay it down on a 15-year or whatever kind of amortization you can create on your own. And you're always welcome to call me post-close. I can send you any type of amortization schedule that you want to target after a 30-year loan. But as you say, you have your job now, but are you going to have your job tomorrow?
Sure.
And I would much rather have that 30-year product with the cash flow coming in if I did lose my job.
Yep, you're right. So you're saying the vast majority of investors taking loans from your firm, they're on 30-year notes, conventional loans.
Correct. Yes, sir.
All right. And what kind of deposits are they typically putting down?
The minimum down for a single family all the way up to 10 loans is 20%. You can go 25% and improve your rate, because there is a little bit of an adjustment between the 20 and the 25% down. But typically somewhere in that ballpark, some people go to 20 because they want to maximize their cash because they want to buy multiple properties. Some people have an abundance of cash on hand, so they'll put the 25 down and, get a better rate.
Okay. And so that's conventional loans. And what about options for people that already have significant equity in their primary residences? What can you do to help those guys?
Well, one of the favorite products that I personally like is called a home line of credit. We refer to as a HELOC. It's a home equity line of credit, and it's typically offered by banks. And I hate to say that, but first lien traditional lenders like ourselves, we really don't have the capacity to offer that because it's really more positioned as a second lien product than it would be a first lien, because most people will get the HELOCs on top of their primary residence, which they already have a loan against. And so most of your banks and some of your credit unions actually is some of the better places to pick up those HELOCs. But I would highly recommend everybody to get a HELOC, even if they're not interested in using it. I have one sitting there for about $150,000, and it has a zero balance on it, but I know it's there, and I can use it at any point in time. A lot of the folks that have seen some significant appreciations in their property in most recent days, they're making use of that equity, and they're going in and they're grabbing it from the HELOC, which they're which they're able to use for down payment and closing costs to transactions for the 20 and 25% down.
So just to reiterate, so you have people that might have a home where it's $400,000, their mortgage is only $200,000. So they're able to go to the bank and take a HELOC and say, give me a line of credit for $100,000, and then they can either use that $100,000 as a deposit on a couple of conventional loans, or they can use that $100,000 just to buy a property outright.
Exactly. They can just go flat out pay cash. Is that the best route in my mind? Not necessarily. My theory is, because I speak from a loan officer's perspective as well as an investor's perspective, is that leverage is your friend. Make use of it, because you and so you might as well make use of the HELOC, and you might as well make use of what's available today. Okay. And I've been saying that since 2008, and I'm hoping with the new administration that we're going to start seeing some improvements in some of the guidelines and maybe some more products to come out on the playing field.
Okay, no, that'd be good. And then moving on, 1031 exchanges seem to be really popular these days. I've a lot of investors expressing an interest in buying rental properties in Tampa, where I'm based, and they're on 1031 exchanges, and they're selling a home somewhere else, and they want to use those funds to purchase one property or a couple of more properties, deferring the tax. I mean, why do you think it's so popular? And does your company help a lot of 1031 investors use those to finance properties?
They're coming out of the woodwork right now. I have a conversation daily about exchanges. I think people are finally recognizing, once again, that they have a significant amount of appreciation on some of those investment properties that, in my mind or in their mind, may be considered as dog properties because it's not generating the kind of cash flow that they should be expecting from that property, but it's got an abundance of equity in it. So instead of trying to hold on to the dog, let's get rid of it and take the equity with us and go buy 2 or 3 more properties from people like yourself with cash flow that's going to make sense. And that's the great thing about the exchange. And there's a lot of lenders out there that unfortunately don't even understand exchanges.
Yeah.
If you look at some guidelines of some of the lenders, it's almost as if they cut and pasted what it says in the code for the IRS. So a lot of underwriters will try to be arbitrators of a 1031 exchange. Well, that doesn't make sense. The money is your money. Okay, if you walk away from a sale property and you have $100,000, well, if you want to buy 3 properties and put divide it up by 3, so be it. That's your prerogative. But a lot of underwriters will say, okay, we're going to Yukon, we're going to buy 2 properties, but you have some money left over. And they're going to reach out and say to the borrower, says, we cannot approve a loan until you explain what you're going to do with the rest of the money. It's none of their business, okay? We're not like that. We're 1031 friendly. And another thing is, like, let's say they want to take the full $100,000 and they want to buy 3 properties from you. One of them is appraisal ready today, which means we can go ahead and conclude that transaction. The other 2, you're just in the acquisition mode.
Right. And
you haven't even begun the rehab. So you could be out another 30, 45 days. But the number 1, you want to go ahead and get it off the books. Well, the way we do it, we can go ahead and close them individually. A lot of lenders say, no, you have to close them all at the same time. And that's another thing.
That's all that struck me, is just pure laziness that they need to, if somebody wants to exchange 3 properties, that they have to be exchanged at the same time, because there's no reason for that at all. I mean, we've done business with investors that have exchanged 3, 4, 5, 6 properties, and there's certain rules you need to adhere to. You need to identify the properties within a certain period of time, generally 45 days. You need to buy them within a certain period of time, generally 180 days, but it doesn't have to all be at once anyway, right?
Well, not necessarily, and you're right. And the beautiful thing about coming to organizations like yourself is that you don't have to compete with MLS. because you're in that crunch time of the 45 days. You don't know if you're going to get that property or not, because you may be getting outbid, and you won't know that answer for sometimes 2 weeks.
Mm-hmm.
Coming to customers like yourself, you've got the product. You're agreeing to sell it to him. There's no muss, no fuss. I mean, it's real easy to accommodate a 45-day exchange using providers like yourself.
Okay. And so what advice do people have? Should they just come directly to you, or should they be, I said the first thing they should be doing is talking to their 1031 advisor, right? Before they even sell the property that they're looking to exchange, they need to get set up with a professional advisor before they come to you or to me, right? I want to clear that up.
Yeah, one of the things about the 1031 industry, they're not regulated like the real estate industry or the lending industry or the insurance industry. There is no regulations, no oversight. So there are some good ones out there, and there's some bad ones. Mm-hmm. And then I've run into a lot of bad ones, and they run amok, and they do whatever they want. And if they've got your money and you want them to send it to the table to close on a loan and they refuse to do it, that's a problem. Yep. So get with a good exchanger. You're welcome to call me. I can give you some names of good exchangers. But one of the things I run into all the time is they don't think through when selling the property to this terminology called like as, okay? It's very important, because I have a transaction going on right now mm-hmm. where there's 3 people that were on title of the loan. Or, 3 people that were in title of the property. There's a husband and a wife and a father. Well, the father I actually did business with, but he's already tapped out on his Fannie Mae loans. He's already got 10. Mm-hmm. So we could not put him on the loan. So what we're doing is we're doing the husband and the wife on the loan. Mm-hmm. And then at the last, we're putting the father in title to adhere to the 1031 like-as rulings. Okay?
Okay.
So be sure when you go into this. Another example, husband and wife. They want to maximize their lending potential. Husband wants to buy 10 properties and use 10 loans. Wife wants to do the same. Well, if you're doing an exchange, make sure that one of those two is off of the title when you do that, because if you don't, then needless to say, you're going to have both of those people back on the loan and back in title. Okay, so you've eliminated that 10 separately. Does that make sense?
It does, and it just goes to say again, make sure you do your homework before you just dive into this. Make sure you find a 1031 advisor who's got a good track record. Try and verify, that they've got some happy investors. If you can go to people like you that work with the good guys, get some recommendations and just write down your timings and make sure you're, there's no point in selling your property and then going on vacation for 4 weeks. I mean, make sure you're getting your research done and then that you're in a position to start lining up the replacement properties for it. So I think it's a good thing, but you need to do some preparation for it.
Well, the great thing about the exchange is, once you've concluded your identification, you have 180 days to close, so that's a good thing.
Yeah, you can go on vacation after that, I guess.
Exactly.
And so getting back to loans then, regular loans, I understand that banks will want to, they lend money to somebody, they want to check their credit scores, their income, all that kind of stuff, but they also oblige them to have certain reserve requirements for each loan, and I understand that those requirements have changed recently. Can you give us kind of a brief overview of that and what people need to be aware of when they're borrowing money regarding reserves?
Sure. Let's talk about a couple things before this. The HELOC that we touched on earlier. Mm-hmm. The HELOC funds, when you go get a HELOC, and basically it's like an open line of credit. So what you do is you strike a check for $30,000, which will include your down payment, closing costs, everything. But one of the things it cannot be utilized for is reserves. So keep that in mind.
Right.
The old policy was for Fannie Mae is that the first 1 to 4 properties, the reserve requirements was having 6 months of principal, interest, tax, and insurance payments on that subject property in reserves, and 2 months reserves PITI on any other properties that are owned. Mm-hmm. Now the new requirement has changed, and they've categorized it in the number of leveraged properties that you own. If you have between 2 and 4 properties, then your reserve requirements is 2% of the unpaid balance of the accumulation of the loans. Let's say you have 2 loans, mm-hmm. $50,000 apiece. That comes up to $100,000.
Right.
the reserve requirement is 2% of that 100,000. So $2,000 would be your reserve requirement.
What do they need to do with that? Do they need to take $2,000 and put it somewhere out of reach, or do they just need to show that they have $2,000 that can be accessed if necessary?
Perfect. Great question. They just have to show that they have it. Once again, the HELOC can't be used, but what can be used is non-liquid funds. IRAs, 401ks, anything that has a statement on it that shows your name, that shows your money, we can use 100% of that asset for reserves. So that's a good thing, because a lot of people, have a certain amount of liquidity to be used for the down payment, closing costs, and so forth, but they may not be running short on reserves. Well, then throw in IRAs. That should do it.
And I guess we should clarify that you can't just borrow money from your uncle for a couple of weeks to show that you have reserves and then send it back to him. You have to be able to prove that it's your money and you've had it in there and it didn't just arrive from a mysterious benefactor.
That is a great point as well. A good example of that is like a kid that just graduated college. He's got his new job, got his new car, he's making some good coin. His dad's been an investor for years. He says, "Hey, son, here's $50,000. Go invest in some properties or two." Well, when he comes to me, he says, "Dad just gave me $50,000. Well, that's called a gift, G-I-F-T. Those are not borrowed funds. That's a money that's being given to the son. Gift funds are not allowed on investment properties. They're allowed on primary residences all day long, but not investment properties. So throwing that $50,000 into an account and we go looking for reserves, we're going to say, where'd that money come from? So, well, Dad gave it to me. Can't use it. Okay. Same if you go get a cash advance on your credit card and throw it in there. Nope, can't use it. We'll figure it out. Trust me.
Yeah. And I believe it. But even just apart from, and I think that's perfectly, it's not excessive at all to have a 2% reserve requirement, and it's not like they're telling you to put it in some escrow account. It's still your money to use when you want, just has to prove it to be yours. And even beyond the bank's requirements, I've always been a very big believer in having rainy day funds. Just in general. I mean, firstly, if you want to be a property investor, I mean, the first thing I think you should have enough savings to pay your family bills for at least 6 months. If you lose your job tomorrow, you should have enough to pay your bills for 6 months.
I agree.
Before you find another one. I mean, if you don't have that 6 months, I mean, it doesn't have to be 6 months for everybody, but I think if you've got a lot of responsibilities, if you have a mortgage, if you have kids, I think you need to put that 6 months and tuck it away in a corner and not use it, and that can certainly satisfy any reserve requirement for some loans that you need. And then
I totally agree.
And then aside from that, just, in general, if you're accumulating rental homes, you should be setting aside part of your rent every month or every quarter just for vacancies and maintenance, because they're going to crop up. People are going to leave every now and again. You're going to have to pay placement fees to get them back. It might be vacant for a couple of weeks a year. Maintenance items always crop up. Things break. Washing machines break. Windows need replaced. I mean, it could be anything. Air conditioners need cleaned out. So you should always be accumulating reserves for your properties. You should always have that rainy day money for your personal life, and you should also have rainy day money for your rental properties. And if you get into that habit, just personally, you're never going to trip up with any of these reserve requirements.
Absolutely. And to kind of broaden that, to answer that question a little bit better, it does stair step up a bit. For the first 2 to 4 properties that are leveraged, there's a 2% unpaid balance requirement, as we just identified. Okay. The 5 to 6 leveraged properties, it jumps up to 4%. Okay, and on the 7 to 10 properties, it jumps up to 6%. So be prepared. Give me a call. Let me explain all this to you again over the phone. Let's take a look at your assets, and if I think you're good to go, then let's do something with Colin.
All right, so 2 to 6% of the amount owed, depending on how many properties you have, and lower amount of properties you have, the lower the reserve requirements. And once you're up to 8, 9, 10 properties, you're going to have to start proving that you've got higher and higher reserves to justify borrowing this extra money.
Correct.
All right. So moving on from that, I mean, nowadays people purchase real estate with all sorts of different entities, LLCs, corporations, IRAs, trusts, I mean, and loads of others. I mean, talk to us a little bit about what your clients are doing these days and how it should be done properly.
Well, a lot of your real estate educators are promoting setting your real estate holdings up as a business, okay? And some people do take it to the extreme. They go through some kind of a training course through a real estate promoter, pay their, for whatever the classes are. They're gung-ho, they're ready to go. They'll go out and get their a website set up and call themselves something LLC, and they'll get a LLC set up for it, get a bank account, the whole 9 yards, when they don't have any properties. And that's all good. But as far as Fannie Mae and Freddie Mac are concerned, they do not do entity vesting. Entity vesting is anything other than the individual names or a family trust, which means no LLCs, no limited partnerships, S-corps, anything other than your individual names. Now, I have this conversation on a daily basis.
And just to clarify this a little bit for people that are starting out, but when you say Fannie Mae and Freddie Mac, if you want a 30-year fixed loan, that means that Fannie and Freddie need to guarantee it. And that means you need to adhere to their rules, and if they don't like LLCs, you need to do it a different way, right?
Correct. Your Fannie and Freddie is always going to be your optimum terms and your optimum rates, okay? There are portfolio lenders. There are other lenders called non-recourse lenders, commercial lenders. There's several different means to getting money, but their terms may not be as favorable. And a lot of times people sometimes have to resort to a non-recourse because they may not qualify on Fannie Mae.
Sure.
Or let's say they did an exchange, they sold the property, but they sold it when it was still titled in an LLC. Well, I can't do the like as on my side because it was in an LLC. So they have to go to a non-recourse lender. So there's all kinds of things that would promote you leaving the Fannie Freddie world, but you're still going to have your optimum rates and terms with us.
So if you haven't reached your 10 loans yet and you're just starting out and you want to get a bunch of conventional loans, your best deals are going to be in the Fannie and Freddie loans, and that means you need to be careful which entity you use. So what should people do then to proceed on that basis?
Well, let me tell you what 99% of my audience does, and I can only tell you what I do. And this is obviously, as a disclaimer, I'm not promoting any of this, but what typically will happen is people do want to have some type of asset protection. They want to put it into their LLC that they've established. So what they'll do is they'll go ahead and get the loan in their individual names. And usually post-close, which I recommend at least 3 or 4 months, they'll have the property itself retitled into the LLC. Now, on the record, every promulgated note that Fannie and Freddie has, there's a thing called due on sale clause, which means if you transfer the titlement of that loan or that property to anything other than your name that was originally established, the servicer of that loan or the note holder has the right to call that note due, which means you got to pay it off or refinance it. Now, off the record, once again, I've been working with investors for 20 years, and I get this conversation on a daily basis. I have never personally seen anybody ever have a note called due. Unless, of course, you want to pick up the phone and call the servicer and say, hey, guess what I'm doing today? But other than that, I've never seen a note called due. Unless, of course, you stop making payment, that's when they call it due.
Right. You're saying most people buy it in their own name, wait 3 or 4 months, and then transfer it into an LLC, and then just keep their head down and keep paying back the loan.
Exactly.
All right. So that's what people do. We're not advocating either way, but that's what people do because if you can't borrow from Fannie and Freddie using an LLC, so people borrow in their own name, and if they want to transfer to an LLC, they do so at their own risk with that due on sale clause, which is there, which they're signing on the contract. But in your experience, as long as they keep paying back the loan, they're not calling those in. But
correct,
nobody's going to guarantee you anything. So
one of the important things that a lot of people miss sight of is that they keep falling back on the old theory of Fannie Mae will give you 10 loans. Okay, so the wife's going to get 10 loans and the husband's going to get 10 loans. Okay, that's all fine and dandy. Well, about 1.5 years, almost 2 years ago, Fannie Mae changed the way the interpretation of that is. It now reads that any 1 to 4 family property, a single family through a fourplex, which is considered residential property, if you own a 1 to 4 unit property and it's leveraged, and your name is entitled, it doesn't matter what kind of leverage it is. It could be a HELOC, it could be whatever, anything that has a lien against that property, it's considered a leveraged properties.
Sure.
So if you think about it in the terms of an LLC, well, the husband and wife has this agenda. I'm going to get 10, she's going to get 10, but we're going to throw them all into the LLC. Well, guess what? The husband and wife both own the LLC. When you go retitle that thing into the LLC, you've just excluded one of them from having another slot for a loan. So keep that in mind.
Right. So they might want to consider having two LLCs, or they should probably seek some advice from experienced professionals before they start messing around with LLCs. And certainly before messing around with LLCs, before messing around with changing ownership of properties that are financed, you should seek some advice from people that have a lot of experience in it. So I wouldn't advise anybody to just run headlong into messing around with those things, because if you do it wrong, you're going to be in trouble. So speaking of getting in trouble, then, I mean, what are the biggest mistakes you see investors making when it comes to financing properties? I mean, what advice do you have for people to avoid the worst mistakes, the most expensive mistakes?
Well, they think getting a loan is an easy process. Okay, fine. And then I had one just the other day. The lady worked for iHeartRadio, which is a big promoter, and she was moving from the East Coast to the West Coast, and they had some offices on the West Coast, and she felt pretty confident that the company was going to pick her up with her personally moving to the West Coast. So she starts the loan process. We go through the whole thing, and then we get down to closing. We go to verify the employment, and when we called iHeart, they said, well, yeah, this lady unfortunately no longer works there. Well, that just completely threw a wrench into the whole thing. Well, yeah. Don't quit your job, okay? Needless to say, try to avoid going out and extending new credit. Don't go buy a new car. Don't buy another property. Unbeknownst to what I'm doing, be as extremely forthright as you possibly can with me, because my job is to get you the loan, but also to keep you out of harm's way, okay?
So, yeah, don't quit your job and in the middle of a loan application. Don't buy a $40,000 Audi on finance in the middle of a loan application, and or don't do it without asking you first if it affects their ability to close on the loan.
Yeah, and like going back to the father and son scenario, let's say we got 2 months of bank statements, which is all we need, and it doesn't show, it shows that he has enough money to conclude the transaction, but all of a sudden we had to update one of the bank statements, so we asked for the most recent one, and then here comes that $50,000 from dad. Well, I can't use that. Don't do that. Okay, so don't throw some additional money into your account unless you can source those monies. Okay, we run into that quite often. So one of the things I can only stress is ask a lot of questions, be extremely forthright. Don't think you're Superman and can get away with something, because we'll catch you. Okay.
Right. Okay. What other mistakes, apart from changing their financial position in the middle of a loan application? What other mistakes do people make that mess things up for them?
Let's think. Really just what I said, acquiring new liabilities is your biggest thing. Having properties that show up that were never disclosed, that's another thing. It's like, oh yeah, I forgot I do own this piece of land over here in Texas, and it's got a loan against it, but I didn't think it was really important because it didn't have a house on it. Well, yeah, we have to account for that liability, and that could throw a wrench into your debt to income ratio. So that's just part of being fully disclosed. Make sure you give us everything that we're asking for.
All right. So can you tell us about any kind of crazy stories? What's the funniest or the wackiest thing that you've come across on somebody's loan application that just kind of threw you off guard? Can you think of anything offhand?
Gosh, let me think.
Putting you on the spot here.
Yeah, you are. I kind of wished I had that ahead of time, because I'm sure I could probably remember some crazy stuff. It seems like they're all crazy from time to time. I can't think of any offhand. Basically, those three notes that I hit a minute ago is really the keys.
All right.
Just be as extremely forthright as possible, and don't do things that are crazy. Call me before you try to go buy that car. Call me before you have to get divorced with your wife. There's a lot of times people will say, I'm going to go ahead and buy this property, but they're still married. Well, I guess what? The wife needs to know that because she's on the account statement. And if I don't have permission from the wife to use those funds, then that's a problem, okay? So that happens from time to time. You have separated husbands and wives that just think they can do what they can on their own, which does lead me to a next good topic, is that on primary residences, pretty much throughout the U.S., most of the time, depending on the state, depending on if it's community state or not, when you're buying a primary residence, typically the wife will have to go on title. Okay, on investment properties, that is not the case. One spouse can buy it without the other one. They do not have to have their name on title or anything. Okay, so keep that in mind.
Okay. All right, and I guess maybe what happens to some people is that once they get approved for a loan, or maybe once it gets appraised, they think that they're home dry. They think it's a done deal and that they can go messing around with their finances. But it's not the case, is it? It's not a done deal until it's closed, and people are checking things out right up until closing. So don't think that you're going to get away with, those car loans or those gifts or changing your job until you've actually bought the property.
And you're right, Colin. I mean, you just be extremely conservative all the way up to the bitter end, because we have mechanisms that, unbeknownst to people, they think, well, you've got my credit, that's good enough. Well, we pull other reports. There's a thing called a fraud guard, which will give us background information. It'll detect other properties that you may own that you didn't disclose. It'll give us a lot of good information. There's another one called a MERS report, which does a very similar exercise of identifying properties. And there's some underwriters can use this program called LexisNexis if they're looking at an individual buyer that may be self-employed and they have suspicious inclinations on this particular buyer, and they can run a LexisNexis report. It's kind of like an abbreviated Dun or Bradstreet or background check or something that goes real in depth. And if the underwriter for some reason doesn't like the LexisNexis report, they can nix that as well. So there's all kinds of things out there that we'll end up finding out about you. But when it comes to the credit, we pull credit once every 90 days, okay? If you're buying a bunch of properties for whatever length of time, if you bought 5 properties in 3 months, we only pull your credit once. But when you go to closing, we do a soft pull, okay? When we do that one pull for the 90 days, it's considered a hard pull.
Okay.
And when we go to closing, we do a soft pull just to make sure you didn't go out and buy that car or that other house or whatever. So keep that in mind.
Okay. That's great. And I understand, Graham, that you've prepared a 2-page guide that I can include in our show notes. Is that right?
Yes, you may.
That's awesome. And so if people want to get in touch with you, what's the best way to do that? Do you have a phone number, email address? What's the best way for people to reach out?
My toll-free number is always your best bet, and it's a direct, and I'm kind of a 24/7 guy. So you can reach me anytime, day or night, or even on the weekends, and that is 855-326-6802, or my email address, which is GPARHAM at highlandsmortgage.com.
Okay, and I'll make sure I put that on the show notes as well. So thanks very much, Graham. Great show. I think that a lot of useful information in there. I mean, borrowing for properties, for investing guidelines change all the time, and I think having that show covered a lot of useful ground. And I think, anybody who's considering how many states do you lend in now?
I'm in 15 now, actually, in about 18 different markets.
Well, there you go. So anybody that wants an investor-friendly lender, you could do a lot worse than reach out to Graham. I highly recommend him. I've worked with him a lot on a lot of different properties. And thanks again for coming on the show. I really enjoyed it.
My pleasure, Colin. Take care.
All right, you take care now. All right, so there you have it, guys. That was Graham Parham from Highlands Mortgage. He is a good guy to know if you're an investor and you want to buy one or more rental properties. He's efficient. He works in 16, 17 different states, and he's got a good in-house team. I mean, he just gets things done and with a minimum of fuss. And I've had my fair share of fuss from lenders over the years, so it is nice when you do come across somebody that just gets things done and is reliable, and Graham certainly ticks those boxes. So, Again, market's really, really busy at the minute. Tampa is just flying it. There's, loads of buyers chasing properties at the minute, and anybody that wants to throw their hat in the ring really needs to have their finances in order. You need to get your pre-approval. You need to get, make sure your credit is there. If you have equity in your house and you're thinking about using it, don't just sit around. Go and talk to your lender and see if you can, what options you have to release an equity line of credit that you can use as a down payment or a full purchase. If you have an asset that is appreciated in value but isn't giving you much in the way of cash flow, do consider a 1031 exchange. Go and find a good 1031 exchange advisor. Don't just pick the first one in the phone book. Try and find one that comes recommended from other investors and check that out. That can make a huge difference to your trajectory if you do exchange a property and defer those capital gains and put it into something that's earning you a good cash flow. So I know a lot of Californians, for example, that are that have these, a house or a condo that might be worth $600,000 or $700,000, but they're not earning a huge amount from it. So they exchange it and they use the profit to buy a bunch of houses in Tampa that are getting them a much higher return. So it's worth investigating. Like I say, beware of reserve requirements. Be aware of your rainy day money. Don't just invest all your money in property. You do need to have savings. You do need to have rainy day money. Good times don't last forever. Bad things do happen. Bills do come in that you weren't expecting. So make sure that you're not caught out when you do get unexpected expenses. Make sure you're not overexposed to real estate, that you have enough rainy day money. I can't emphasize that enough. And again, if you're dabbling in entities, if you want to, protect, if you're interested in asset protection, as everybody should be, do your homework. Don't just put everything in an LLC and assume that you can finance it at a 30-year fixed rate from an LLC. You can't. But there are ways of doing it. You need to talk to professionals. You need to be careful. There's always a balance to be achieved between asset protection and getting the best possible finance for your money. It's you can't have the best of both worlds. There's always a little bit of give and take there, and just avoid those mistakes. Like Graham was saying, if you're lucky enough to have been pre-approved and lucky enough to have reserved a good property, don't mess it up by quitting your job or buying an expensive car or getting an unexpected or unexplainable cash gift. Just make sure that your finances are steady and boring during that whole process, because you can get caught out. And again, it's like anything else. The first time you borrow money for a rental property, it's a bit daunting. It's a little bit complicated and a bit stressful. But if you can get it done, it's great. And if you're doing it a second or third or fourth time, like everything else, you'll find that it gets easier and you learn more as you go along. I'm not going to say you're never going to make any mistakes. People do make mistakes, but just learn as much as you can from the mistakes of others before you start making your own. That's my advice. And again, thanks for listening. This is the 25th podcast. They've been going really well. I'll try and do them more regularly now. Any feedback is greatly appreciated. Any reviews you can leave us on iTunes or SoundCloud or wherever else. Any ideas you have for future podcasts, just send them on to us. Just go to our website, torcana.com, torcana.com. And feel free to reach out to me. My email address, my phone numbers are all on the website, so check them out there. And thanks for tuning in. Really appreciate it. This is Colin Murphy from Torcana, signing off. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.